Oh, if you've been hiding under a rock or haven't seen my Twitter feed, my goodness, what did the Fed just do? Dropped interest rates down to zero, plus announced 700 billion in quantitative easing. And I think this time they're actually admitting that they're doing the quantitative easing. Ah, man, these lights. You guys are going to have to bear with me tonight because the lights, I don't know how to set these up. And Sebastian, I'm sure, is laughing at me right now. I tried to figure it out, but obviously the lights aren't very good. So you'll have to forget the horrible lighting. You're just here for the content anyway, right? Let's do some housekeeping before we get into, I'm sure, all your questions about what the Fed just did and what that means. And I just tweeted out that this is, and also to add to that, this huge stimulus. The last time I checked and looking at Eric Townsend's Twitter feed from Macro Voices, the Dow futures opened limit down. I mean, this is huge. So they dropped 50 basis points. Market goes down by 700. They announced all the repo market action the other day. Market goes down by what, 2,000? and then they do this and the market still limit down. We'll have to see what happens tomorrow. But holy cow, just unbelievable. Let me go through some house cleaning here. We have got a lot to talk about, so sit down and buckle up. This is going to be a bumpy one for sure. Okay, let's see. Sebastian is texting me. Yeah, hopefully. So Sebastian, I've got the cable on. Are you having let me know if you guys if the feed is freezing, and let me make sure that you guys can hear me. Can you type that into the live stream? Lighting is fine. Okay, thanks, Joe. Okay. Oh, Sebastian's telling me everything is fine. Okay, good deal. So we'll go ahead and go into it. So guys, first thing is I've got an announcement. You've all been waiting for. It's regarding none other than Peter Schiff. Give me a drum roll. The announcement is Peter Schiff has confirmed to do an interview this Tuesday. So I am super excited. It's the interview that all of you have been asking. I cannot wait. And it's not that we're going to publish it on Tuesday. We'll probably try to publish it on Wednesday, Thursday, something like that. But really, really cool stuff. I know on Twitter, so many of you have been pounding the table and said, get Peter Schiff on, get Peter Schiff on. I keep saying, I'm trying. I've emailed him a few times. Honestly, I didn't think the channel was big enough yet for him to do it. You know, you got to be honest with yourself. I still only have 70,000 subscribers, which isn't a lot, and I'm still kind of a small fish. So, but it was great to hear from his assistant and to get that set up. So, great news. We're going to be interviewing Peter Schiff. Also, wanted to go over the Catoosa research. That's going to end tonight at 11:59. We ended that deal because we had an email mix-up. I sent out an email. Finally, we're using Aweber, which is a much better provider. So you guys shouldn't have an issue getting the emails on a moving forward basis. But that $1,500 off of an annual subscription to Catoosa Research, that ends tonight. So if you want to take advantage of that, make sure that you go to our affiliate link. It should be in the description below. Or if you go to my website, georgegammon.com, and click on the resources tab or recommended resources, you'll see newsletter. There'll also be a link to it there. If you've been thinking about subscribing to Marin's newsletter, now's the time to do it. Great way to support the channel and get a smoking deal. So, and if you have any questions on that, make sure you email Sebastian at georgegammon.contact@gmail.com. Next announcement is I have officially told all of my people to work from home. So all the people that you guys know, like Sebastian and Thomas and Danny, and even the gal that does all the stuff around here. You guys don't know her, Kayla, but I've everyone working from home. So next week we are not going to do the whiteboard videos. I'm still trying to figure out some sort of content. I will be uploading content, even if I have to do a live stream, to make sure that we're still doing interviews Tuesday, Thursdays, trying to stick with that schedule, and then some sort of alternative for the whiteboard videos. Maybe I go over the news or something like that. But just for while we're dealing with the cerveza sickness down here in Colombia, I want to be as safe as possible with the health of my employees and all the fantastic people that work for me. So I know it's not everyone's favorite on the YouTube channel, but obviously it's what's most important right now. Got to keep our priorities straight. You got that? All right. And one last thing that I want to point out, when you guys are looking at what's going on in the market, I would strongly suggest going back to a video that I posted January 27th. And it was cerveza sickness. Could it be the next black swan? And I pretty much outlined January 27th how this could play out. And we're seeing it play out in real time right now. I'm not saying this to brag or anything like that. The reason I'm bringing it up is because I want to point out the fact that I almost flunked out of high school. I've never taken an econ class in my life. I've never taken a finance class in my life. So if someone as unqualified as me can see this coming just by paying attention, every single one of you on this live stream can do the exact same thing, because I can promise you I'm no smarter than any person on the live stream right now. It's just I pay attention and I study this stuff. So I wanted to bring that up. If you want to check it out, it's the video I posted January 27th. Pretty much the only thing I got wrong was at the end of the video, I said that the probabilities of this coming to fruition probably wasn't that high. And as it turned out, the probabilities were extremely high. But anyway, I just wanted to point that out so it gives you guys kind of a boost of confidence that you can figure this stuff out as well. Okay, let's dive right in. We've got a bunch of super chats. If you guys want to make sure that I see the super chats, make sure you do that. Sebastian will text those to me in real time. If you have another question for the live chat stream, make sure you start with question in capital letters, or else there's no way I'm going to see it because it just moves too quickly. We've already got 1,800 people on the live stream, and I'm assuming that will go up. So let me dive in ASAP. Tricky Dicky, thank you for the super chat, my friend. Greatly appreciated. Alex, thank you for the super chat. How will this impact buying a multifamily home? Probably going to lower interest rates, probably going to make that financing harder to get, would be my guess. I've been telling people this on the last few live streams, and I'm going to stick to this for the time being. And that's if you've got a property already picked out that's absolutely perfect. The numbers make sense. The neighborhood makes sense. The type of renter you can get in there makes sense. And you've already got your financing lined up and you can lock in that 30-year fixed rate. I would most likely pull the trigger if it were me. If you don't have that perfect property, I would hold off. I would just wait to see how this plays out. I would keep the dry powder because you guys know well I'm a real estate guy, but we could see stocks go down so much that you might even be able to get a better deal short term in the market while you're waiting for the real estate market to come down further, because the real estate market, there's quite a lag It's not like the stock market where it just crashes overnight. It generally takes months for the sellers to come to the reality of the situation and start dropping their price. Tricky Dicky, another super chat. Thank you, my friend. It makes me sick that they can pump so much money into the markets. When is the whole saga going to come to an end and the Fed's craziness keep up the good work? It might have already come to an end, Tricky. Just like my buddy Eric with Macro Voices tweeted out, this could mean the end of the Fed put. That's the big, if that comes to fruition, that's the biggest news since they announced QE1 in the first place. If the Fed is out of ammo and they cannot control the market or give it any type of support, I mean, who knows the bottom? It could go way lower than it went in 2007. Even in nominal terms, I've always been saying that kind of look for that floor adjusted for inflation. But boy, oh boy, hey, if nothing the Fed does stops the market from going down further. And what's very interesting is we could be in a situation that I never even thought of. And that's every time the Fed does something to support the market actually takes it as a negative because they're maybe seeing the Fed signal something that they should be worried about. Isn't that interesting? So the market's just looking at the news, playing it by feel. Okay, it's bad. It's not that bad. Obviously, we all know how bad it is, but I'm just talking from the standpoint of the market, where all of a sudden the Fed comes in on a Sunday, and they were, 4 days before they were supposed to meet officially, and drops rates by 100 basis points or 125. I don't, and you guys might have this right at the tip of your fingers. I don't think they've ever dropped rates by that much in one session. I think it's historic. And then in addition to that, you're announcing 700 billion of QE, which I don't know how will work. Like, okay, all you're doing is you're just doing an asset swap. And think about this. If Jeff Snyder is right, and the problem with the repo market and the lack of liquidity in the whole system is a result of not having enough collateral and just being flushed with the reserves, but not enough collateral. What is quantitative easing? It's taking collateral out of the system and replacing it with reserves. I don't want to put words in Jeff's mouth because obviously he's 100 times smarter than I'll ever be. But I'm really looking forward to seeing some of his posts tomorrow on Twitter and on his blog at Alhambra Investments, because I'll bet you his take is going to be that they're just doing this for window dressing. They're just doing it smoke and mirrors. It's really can't be something they're trying to use effectively to boost the market. It's just like a confidence game. And it goes back to what I've been saying, as you guys all know, it's the government and the Fed versus reality in that battle for confidence. And boy, oh boy, is reality winning right now. Holy cow, man. All right, got to stay focused here. Stay curious. Thank you for the super chat. Which companies do you think will go bankrupt? I think you might be asking the wrong question, or you're asking the question the wrong way, my friend. Which companies will not go bankrupt? I don't want to be too alarmist, and I think they'll be bailed out, but everyone is going to lock themselves in their house. There's not, I mean, which companies that you know of can sustain that, where they just don't have any customers for the next 2 or 3 months. So obviously I'm using hyperbole, but there's going to be a lot that will need to be bailed out. Now, I'm not saying they should be bailed out. I'm not saying they should or shouldn't. I'm saying there's going to be most likely a lot that will be in need of that. So that comes from the government. That type of spending increases deposits, but then it goes right back into the reserves. I really need to do a video on this, because I know when I'm talking about increasing deposits, that most of you really don't know how that's different from just creating reserves. And what I should do maybe is do that on the video tomorrow. It won't be a whiteboard video, but I could at least explain that a little bit better. Vara, thank you for the super chat. If there was a time to be overweight gold, it's right now. Long term, yes. I think short term, it all depends on how the collateral issue plays out in the repo market. But I'm a long-term person, so for me personally, I'm not like trading this in and out week by week. I'm seriously looking at silver and the silver miners tomorrow. The one good thing about me not doing whiteboard videos is believe it or not, guys, like a 15-minute video takes me like 4 hours to shoot. I know a lot of you think I just go up there and just rattle it off like 20 minutes. No, it takes a long time. So I'm actually going to have a little bit more time to focus on allocating my own portfolio in a direction that might make me a little bit of money. Hopefully, we'll see. But if I do anything, obviously, I'll let you guys know. Jacob, thank you for the super chat. Why doesn't negative interest rate cause bank runs? Because they're not charging negative interest rates to the depositors yet. I think they might have in a couple places in Europe, but you've got to remember, Jacob, that even in the United States, and I'm looks like you're maybe texting in from New Zealand, and I'm not sure how the interest rate, what the interest rates are there relative to inflation. But in the United States, we all think that we're this bastion of safety because we have positive interest rates, but they're actually negative in real terms. Just because you might be able to get a 1%, which I doubt you can, but maybe 1% in a bank account, if inflation is running at 2%, and that's according to the CPI, you're still losing purchasing power. And then if inflation is up near 5%, or maybe even closer to 10%, like a lot of us know that it is on certain goods and services, then you're losing a lot of purchasing power, even though we supposedly have positive interest rates. There's a big difference between nominal rates and real rates. So even though you may see negative interest rates, even on deposits in like maybe a Denmark, they could have actually higher real rates than the United States. Figuring out money. Thank you for the super chat. I bought medium-term SLV call options into Friday close and plan on buying longer. Okay. What are your thoughts on this play? I would look at that last video I did with Patrick Serezna, part of the Rebel Capitalist education series. And I think that's might not be exactly what he's doing, but he's doing something like that. And I'm not an expert on options. I'm just a beginner, just like everyone else. But Patrick is an expert. That's why I had him on to teach us and help us understand better. So I would go through that video and try to answer that question through what Patrick says. And keep in mind, this probably Thursday, we'll be putting up the final episode of that educational series on options. Coleman, thank you for the super chat. Thanks for lunch a few weeks ago. At the time, I told you I have a put option NASDAQ. Okay, strike price 75 expires end of the year. How far can the NASDAQ or Can the Fed pump this sinking ship back? Thanks for all your help. Guys, I wish I could click off my screen and look at the futures, but I don't want to do it because I don't want to hang up the thing on accident. But maybe you guys can tell me what the futures market's doing right now. Honestly, Coleman, I don't know if they can prop it up because, like I said earlier, maybe now when they announce a QE or a lowering of interest rates, the market is now just completely flipped. It's crazy how fast the market went from bad news is good news and good news is good news to now it might be good news is bad news and bad news is horrible news. And if that's the case, I think that the NASDAQ could just get crushed, especially considering what's really holding up the NASDAQ, although obviously it's down, but are the FANGs. And most people don't understand that advertising is wildly cyclical. That means Google, Facebook. That I don't think people really grasped that yet, that although I'm not saying Facebook or Google are going out of business, but their revenue could take a huge hit over the next few months or so. And also, I don't know if you guys saw this on Twitter today. And if you're not following me on Twitter, make sure you do that because I try to post up any of these alerts that I get on my feed. But I don't know if this is the New York Fed, or actually, I'm sorry, it might have been Goldman Sachs came out and adjusted their second quarter GDP projection from like a +1 down to a -5. -5. Just let that sink in for a moment. And looking at the China PMI, that might be optimistic. TCP, thank you for the super chat. Per your advice last time, I put a collar on some of my gold position. It was a 50% portfolio. Thanks for that. Does the Fed's nuke change your views about 50% gold? No. I know what you want me to change my mind to make you feel better, but I'm not going to do it, buddy. I totally respect your opinion and your decision to do that for your own portfolio. But as far as my personal portfolio, I would never put it 50% gold unless I was just an options ninja like Patrick. And obviously I'm nowhere close to that right now. So, and even then I don't think I would do it. I'd stick to my guns, 10%, 80%, 10%. But more 2,300. Thank you for the super chat. Gold miners crushed. Wait and see if they go down more or go in. It depends. If you're for long term, I mean, I'd start buying now. Well, who cares what happens in the short term? Because long term, meaning over the next 3-5 years, they're going to be a lot higher than they are right now. Most likely. Nothing's certain, of course. But the probability is very high that they'll be at a much higher price. But if you're just kind of one of these traders that's trying to bet on where it's going to be over the next 2 weeks, I have no idea. I think the best way to figure that out is understand what Jeff Snyder has taught us about the repo and the collateral issues back in 2008 and how that potentially affected the gold price when you consider the three major cross currents back then: fear, collateral, and liquidity. Jason, thank you for the super chat. Looking forward to the interview with Juliet DeClercq. So am I. Juliet's really, really fantastic. And she's going to give us a different view, which we should all respect and look forward to, because she is just wicked smart and really, really cool gal too. I met her up at Macro Voices Live last year, and she's just a really neat gal, and just has incredible insights to the market. So I'm looking forward to that too. Basically, where we are with that, I text Juliet the other day. She's totally stoked on doing the interview, but she is just swamped right now, as you can probably imagine. So we're going to wait for things to settle down a bit and then hopefully move forward. And if you guys aren't following Juliet on Twitter, I would suggest doing that as soon as we get off the video. I think it's JDI Research. That is her handle, but it should be pretty easy to find. She's on Macro Voices all the time. Toro, thank you for the super chat. This will not end even in 1 year. It's total economic destruction in the EU. Europe looks like after World War II. You are not ready for this in America. Yeah. Unfortunately, I think you may be right. And I just listened to the most recent Macro Voices episode that Eric came out with today, which is incredible. He interviews a gal that's in the finance and in the macro world that's quarantined in northern Italy right now. So she gives a boots on the ground view of how this is playing out, how it's overwhelmed the hospital system, and how quickly it hit them. It just almost overnight went from no one really paying any attention to it to the very next day, everyone's got out their masks and not even coming within 6 feet of one another, to the next day, everything's completely locked down. It just happens so quick. And my concern, well, I don't know if that's my concern in the United States, because I think that's really the only thing that would slow it down in the United States. They're still just tap dancing around it. And from a libertarian standpoint, I struggle, because I don't like the government coming in and doing anything. I think it should be a bottoms up type approach to this, where we as citizens that care about our families and our communities take it upon ourselves to do everything that we can to not get infected. I don't care if you're under 60 years old. You're most likely not going to have severe problems. It's not about that. It's about you spreading it to another 500 people when you're not having symptoms, and that creating this chain reaction that completely overwhelms the hospital system. That's what people just don't understand. So anyway, make sure you listen to that interview with Eric. You guys would really love it. Baruch, thank you for the super sticker. Says you are amazing. I don't know if I'd go that far, but I appreciate the kind words. Chris, thank you for the super sticker. Thumbs up. Tricky Dicky, another super chat. Schiff, and you were right. 100% Fed cuts rates to zero. QE4 bigger than all three previous QE programs. It's crazy. Where do you think this will end up, George? Could the USA go bankrupt? No, they can't go bankrupt. Not technically, because they can print their own money, unless you consider a default being that they're just paying people back in dollars that are devalued, and then that's probably a given. There's no getting around that, especially now. But they're not going to go bankrupt. They can't go bankrupt. Maybe there's some way that I'm not thinking about, but the bottom line is they can print dollars, so they're not going to go bankrupt. Hey, George, or excuse me. Okay, 1TS Sen. Hopefully I'm getting that right. Thank you for the super chat. Hey, George, is my pension toast? Depends on what you have in your pension. I mean, I'm assuming it's like the S&P or components of the S&P, which is why you're asking. Hopefully you've got some bonds in there to protect your downside. At least bonds have gone up, but at the long end of the yield curve, who knows? I mean, I'll be really interested to see what the 10-year and the 30-year do tomorrow with this announcement from the Fed. Remember, every time they've announced or they've done quantitative easing, which is completely counterintuitive, it's made the 10-year rates go up, not down. If we have that again, rates, I mean, I can't even imagine what would happen if the stock market was going down like this and the rates started to increase on the 10-year and the 30-year. That would be just catastrophic. But unfortunately, unless you've got some gold, I don't know any way to sugarcoat it. I think you're going to lose quite a bit of money in your pension. Hopefully you've got some dividend paying stocks and you're getting that cash flow, assuming that they continue to pay their dividend. But I think you're going to take a hit. And the reason I'm saying that is because even now the stock market is still very high. Most people are saying buy the dip. You'll never get this opportunity again in your lifetime because the S&P is at the same levels it was 4 years ago. Those people don't understand that. They don't look at a CAPE ratio. Look at a CAPE ratio going back as far as you can. You'll know exactly what I'm talking about. It went from 30, maybe it's down to 23, 25 right now. But to be just even reverting back to a mean, we'd have to go probably to 15. So there's a long way to go just to revert to a historic mean on the CAPE ratio. The Foodie Wizard, thank you for the super chat. Question, George, you're the best. I appreciate it. Would you advise to continue to buy gold and silver or hang on to USD cash as dry powder? It depends on what your time horizon is. I'm assuming you're a long-term person, in which case I'd think about gold and silver right here. And with the speculative side of your portfolio, I would definitely think about the miners, if you know what you're doing. But I like USD cash too, because I like to make investments that pay me to own them. And if I can get some dividend paying stocks that pay me to own them, I like to have some of that as well, because the silver and the gold doesn't pay you to own it. The silver I'd consider a speculation, gold I'd consider insurance. So if possible, I'd like to do a little bit of both, assuming that my time horizon, which mine is long-term, 5-year, 10-year. Baxter, thank you for the super chat. Given we're back at QE, are we basically back 2008 level crisis now? I'm assuming you're referring to the stock market. What I've said before is it wouldn't surprise me if we went down to that level adjusted for inflation. Now, if the Fed put is gone, we might be able to get down there in nominal terms. So S&P under 1,000. I'm not saying it's going to happen overnight or next week, but I'm saying over the next, call it 3 months, 4 months, 5 months, we could potentially see those levels. And nothing's certain, because the Fed, I've had the opportunity to talk to a lot of inside people that are in the trenches trading every day. As you guys know, watching my videos lately in my interviews, a lot of people, a lot of pros, a lot of people smarter than I am, think the Fed has some more tools up their sleeve. We'll see. We'll see if those tools work, because I'm sure they'll be pulling them out of their bag ASAP. Cliff, thank you for the super chat. Hey, George, I'm a casino dealer. I don't like the idea of being around all these coughing tourists at the moment. What do you think, health or job? Yeah. I want to be clear. The main reason I'm choosing to go outside or to go out as little as possible and trying to like self-quarantine, even though Colombia only has 32 cases right now, and I'm sure they've got a lot more than that. That's just due to low testing. Is because I'm not worried about myself being sick. I'm in pretty good health. In fact, for my age, I think I'm in extremely good health. I work out all the time, do a lot of cardio, do a lot of boxing, a lot of jogging. So I'm not really worried from that standpoint. I'm worried that I don't know that I have it. I'm asymptomatic and I'm spreading it to all these other people that could be in a state of health a lot less, or that could be in a worse state of health than I'm in. It's more of a social responsibility as just a ethical individual. But if it were my job, I think you got to keep the job. I mean, you cannot try to quit your job and go into a market, especially if you're under 50 years old. That again, that the probability of you having serious health consequences as a result are probably very low. That's not the reason we should be scared of this virus. It's overwhelming the hospital system. It's not really on how severe it is for people under, call it 50 or 60 years old, unless you're a smoker or if you're extremely obese. Those are other huge risk factors that nobody's talking about, in addition to the age component. So I think if I was in good health, I would stick with my job. You really don't want to go out into this type of environment with no job unless you've got a lot of savings that can weather you through a potential real storm. Foodie Wizard, thank you again for the super chat. Is there any way that you could give us your watch list of stocks to purchase? I was looking at the cruise lines. I don't know if I'm as excited about those anymore, because I think they'll probably be the last ones to be bailed out. Because the more I look at it, I know they're typically not owned by onshore entities. I'm really looking at the oil producers, just your standard Exxon, Chevron, Shell, and that's pretty much the main focus of my watch list right now, as far as those stocks that I would consider investments, because they're paying you so much to own them. That doesn't mean that I've purchased any. I've just got them on a watch list. But this week, since I'm not doing whiteboard videos, I'll have a lot more time to research that and create a much bigger watch list, which of course I'll share with everybody. NB, thank you for the super chat. I appreciate truth tellers like you. Well, I appreciate you guys taking the time to watch the videos. I forgot whether I was on Twitter or maybe the comments the other day, but I told someone that, a viewer, they were thanking me for doing what I do, and I reminded them that I'm 100% confident that I get a lot more value from doing these videos and interacting with all of you that are on the live stream or in the comments or on Twitter. I get a lot more value from what I'm doing than I think you guys get from what I'm doing with producing the videos. So I would have to thank you guys first and foremost. And then I'd also have to remind you that although I try to do my best to research these things, tell you what I think is going on, remember, I almost flunked out of high school. I don't have any type of finance degree. I've never taken a class in this. I'm just self-taught, just like most of you. And so keep in mind that I'm far from perfect. And you guys have to remember that when I talk about things, I'm just talking about things that I think are most probable. And I'm not giving time horizons. I don't do that. No one knows that stuff. And I'm the last person to know what is going to play out. No one can be certain of these things. I don't care how good they are. And so just remember that when you're watching my stuff, you've got to realize I'm doing the best that I can. I've got a lot of these things right lately, but I'm just giving you probabilities, and nothing I say is written in stone. You guys have to just use it for further information to bounce that up against other opinions and other people who do their research and may have an opposing view. Always keep that in mind. You don't want to get in this echo chamber of just listening to me, Peter Schiff, whomever else that you listen to who might agree with me. Try to get some alternative views, not from dummies and people who are just blowhards, but people who really do their homework and who see things that you think see things clearly and have a good motivation and an ethical moral or an ethical North Star. Hopefully that makes sense. Stacy, thank you for the super chat. Apparently the Fed is eliminating all reserve requirements. I saw that as well. Yeah, Stacy. That's huge. Let me read this again for you guys who didn't see it on the live chat. Apparently the Fed is eliminating all reserve requirements for banks so the banks can lend into infinity. Thoughts on ramifications? My thoughts initially are do we really need that when you're doing 1.5 trillion a week when you're committing to 1.5 trillion a week in repo and 700 in quantitative easing and interest rates at zero? I mean, do you really need to lower? We got 1.5 trillion in excess reserves, and that's going to go to the moon this next week. It almost seems like they're doing it just to try to gain that confidence and get ahead of the curve that we talked about earlier. I just don't know how that would make any difference. But there again, I'm not an insider. I'm just like you guys, outside looking in. Ramifications, of course, huge unintended consequences. Who knows how the banks are going to use that, like the offshore banks and the banks in Europe who have used that foundation to create a euro dollar market that now, according to Jeff Snyder, exceeds the domestic dollar market to the point where it's actually the reserve currency. Remember, from his standpoint, and I think it's tough to argue with Jeff on this, the whole reason we went through 2008, 2009, and we're going through this, it's not necessarily the cerveza sickness. It wasn't necessarily the mortgage-backed securities or the mortgages going bad or the housing bubble. Those were the pins that pricked the bubble. The big issue was the euro dollar market has never been fixed. In other words, the dollar funding market outside the United States and now inside the United States was never, ever fixed. And I don't think that what they're doing right now is fixing it. And I would guess that Jeff would agree with that. And I keep referencing Jeff because he's the foremost expert on this, in my opinion. So ramification, yeah. And then also you got moral hazard with that long term. Is this something that they're just going to leave in place indefinitely? So you got unintended consequences and you've got some severe moral hazard there on a moving forward basis. And I don't know that it's necessary. I just don't get it, other than just confidence. Take Kaiser, thank you for the super chat. Take my money before my bank goes bankrupt. I hate to laugh, buddy, but what are we going to do? We can either laugh or cry. Yeah. I think it's good to have some cash right now for sure, outside of the banking system. Connor, thank you for the super chat. Do you think bad collateral is the effect of price controls on interest rates? In my opinion, no collateral is safe enough for the rates the Fed is trying to maintain. I'm not sure that the bad collateral, well, maybe you got a good point, Connor. Because if interest rates, I mean, this goes back to Greenspan. If he wouldn't have had that Fed put and created that in the first place, would we have had all of those mortgage-backed securities that went bust, that the system was using as collateral back before the GFC? Most likely we would not have. So you can take the blame and put it back onto the Federal Reserve. It's like I always say, when you peel back the layers of the onion, almost every problem that we have today, and this goes for, in my opinion, poverty, a lot of things that you'd never think of, those issues start with the Fed and what they've done since 1913. So I think you may have a great point. No, as far as no collateral being safe right now, I don't know that that's up to us to decide. Right now, the repo market is deciding that, and the dollar funding market, and it's quite obvious that they are looking at T-bills as safe collateral for sure, because everyone's scrambling to get it. It'll be interesting to see what the rates go on the T-bills tomorrow as well, like the 3-month especially. Mark, thank you for the super chat. Being the fact that the Fed is going to pump trillions, would buying a spread of junior miners long-term do well? A lot are down 40 to 60%. I'm considering it. I want to be clear. I haven't done anything. I'm not saying go out and buy it. I am saying that I'm considering it. I agree that 5 years, 10 years, I cannot see a situation or a scenario play out, where the miners aren't higher. That said, especially with the juniors, a lot of them could go out of business. So you got to know what you're doing. And I think that this is, just to give the guys at Katusa Research a plug, this is why it's so important that you, if you're not subscribed to Katusa Research or a newsletter like that, make sure that you're paying attention to this stuff as well enough to where you could write your own newsletter. You can't just go into this blind, especially with the junior miners. What I said in the email blast that Sebastian sent out today is I just gave reasons why I have been reading it. And the main 3 reasons, when I was an entrepreneur, most of you guys know that I retired as an entrepreneur back in 2012. I learned a lot. And a few of the keys that made me successful is I learned very quickly that you've got to know what you don't know. You also have to understand and be honest with yourself what your strengths and your weaknesses are. And when you see talented people, or you've got to seek out talented people and figure out ways that they can make you money. So my point is, that's why I've been personally reading Katusa Research, or why I'm going to read more newsletters in the future. I really want to start reading Grant's Interest Rate Observer for sure. And there's a couple others that I might start reading. If I do, I'll let you guys know. But I don't have affiliate deals with them or anything. It'd be great if I did, because I've got so much confidence in their product. But all of you, of course, know Grant's Interest Rate Observer. But my point is that I got to know what I don't know. So I don't know a lot about the junior miners because I don't have time to research it. Okay. I get it. So then the next step is I've got to understand my strengths and weaknesses. Well, I don't have time to go out and go to a physical mine or an oil well or talk to management. I don't know that I could even do that even if I had time. So by reading a newsletter, whether it's Marin's or Grant's Interest Rate Observer, whatever you like the best or whatever resonates with your style, by doing that, you're taking that weakness and turning into a strength because they're doing that groundwork for you. Then, of course, number 3, you're looking at someone who is extremely talented. If you think it's Marin, great. If you think it's Jim Grant, that's great too. But you're looking at that talented individual and trying to figure out how you can leverage them to make more money for your own portfolio. So that's I know it's kind of a plug there. I didn't mean it to be salesy, but I think it was appropriate for your question. But even if you don't want to do a newsletter, you got to do that research yourself, Mark, to figure out what to buy and what not to buy, because we could see, especially in the juniors, a lot of those businesses going out of business, which if you buy the right juniors is wildly beneficial, because what's the cure for low prices? Low prices, because that creates an environment where the weaker entities go out of business, the stronger entities take market share, and then when the prices do go back up, those stocks are going to go up even further than they would before because there's not as much supply or suppliers. David, thank you for the super chat. JP Morgan just announced it is ending stock repurchases. What does that mean, or why would they do that? Well, they don't want to buy their own stock back when they know it could be half price in 2 weeks. That's my guess, David. But to take it to the next step, we've got to realize since 2010, the main net buyer in the stock market has been corporations buying their shares back. Any of you that have been watching my videos, you know that. So if the main buyer in the stock market are corporations buying their shares back and that buyer is gone, what's the bottom look like? Is the Fed going to have to come in and buy shares? Maybe. As you guys know, I talked about that in my video the other day, and I think it could be a possibility. And in fact, a very good possibility, because obviously what they're doing now isn't working. We'll see how it plays out tomorrow. But I actually, just for the sake of the economy and people's pensions and everything, although I do want all the malinvestment to get out of the system as quickly as we can, because we as you guys know, we've got to take the medicine at some point. We didn't take the medicine in 2008. Look what it's done. The problem just got bigger and bigger and bigger. Now, if we take the medicine sooner than later, although it will be hugely detrimental and it will cause tremendous pain, it will cause less pain than it would if we kick the can down the road another 5 years or so. So that said, I've got that debate going on in my mind, where on the other hand, I'm like, I almost wish the market would go down in a less volatile way, that what the Fed's doing would quote unquote work. And not to prop the market back up, but just to keep it from going insane, because there's going to be a lot of people that are going to get hurt as a result of this. And it's just really unfortunate. Bouncer, thank you for the super chat. ZERP's zero interest rate policy effect on 30-day T-bill. pull out or reinvest because safer than risking bank bail-in. Well, I would prefer to have, especially any money that is in a bank account that exceeds the FDIC limit, I would prefer to have in T-bills because you're going to get that principal back. Even if we have inflation, it doesn't matter where interest rates go. We're not going to have that much inflation over the next 30 days. So you're guaranteed to get that principal back. And then if you want to, you can keep rolling it over. And I think that's a safer place to store my cash or my dry powder compared to a bank account that is at a level that exceeds the FDIC, assuming you don't want to keep it in your back pocket. If you got 100 grand, I might feel better if it was in my back pocket. Obviously not literally, but you know what I'm saying. Matt, thank you for the super chat. Can you explain commercial paper short-term debt? Well, commercial paper is just the corporations selling debt. It's just like a T-bill for a corporation. So I've got to do some more research, but I was going back and forth on Twitter, and if I'm understanding what's going on correctly, and don't quote me on this because I've not had time to really dive into this and think this through and understand it, but I think that the Fed has done something to extend the credit lines for the major corporations. So basically what they're doing is if you're a corporation, you need short-term money and you need it badly, they're setting up a system so you can have easier access to that. They're also dropping, from what I've heard, they could potentially be dropping the interest rate on the discount window, which there's two schools of thought there. Jeff Snyder says, well, it's kind of irrelevant because no one's going to use that discount window because then you get this stigma where the market's going to treat you as though you're already out of business. There's other people that I've seen like Danielle DiMartino Booth and a few other people that have said this is a good move because it allows all the other banks and entities that aren't under the Fed's umbrella, that might not have access to Fed funds. It gives them a way to access funding regardless of the collateral. So in other words, you wouldn't have to have treasuries. You wouldn't even necessarily have to have mortgage-backed securities. From what I saw on the Fed's website, you could go in there with corporate debt. And so that opens up a lot of opportunity. But if the markets limit down, I'm sure the markets read this just like I have. So they might be shaking that off as well, which, boy, oh boy. Okay, let me get back to these super chats. And one person I want to give a shout out to, if you guys haven't seen my interview with George Goncalves, make sure you do that. He's a bond insider. He's been a strategist for over 20 years. Tremendous insight on what happened last week. Follow him on Twitter. And I think it's Bond Strategist is his handle. And make sure that you're checking out that video Saturday. That'll give you a lot of insight to what happened last week. Maybe Sebastian, if you can put his name in the chat here, I'd appreciate it. Okay, we answered that one. Hans, thank you for the super chat. Bank reserves dropped to 0. Thoughts? I just discussed that, Hans. I think bottom line is I don't know that it really matter because of all the other liquidity things they're doing. And I think the only thing it's going to do at best is just give some confidence to the market I think the upside is that it gives some more confidence to the market. I think the price they're paying is long term. It gives us even more unintended consequences and more moral hazard. So I just don't see the rationale for it at all. Look at it's so asymmetric. Your upside is so small and your downside is so huge. Unless there's something in the plumbing that the pros see that I don't see. And obviously that's very possible, but it's a liquidity thing. The only reason they dropped the reserves is to increase the liquidity. And how could you need more liquidity when you just offered or committed to 1.5 trillion and it was totally undersubscribed? It wasn't over, it was undersubscribed by like they did the 500 billion, I think Friday morning, and they only had demand for 17 billion and they're offering 500. So I don't see that as a liquidity issue. So bottom line is I don't think it'll do anything, and all they have is just downside. So why do it? Happy Cakes, thank you for the super chat. Last time they had 2 emergency cuts, bank failing, Deutsche Bank failing as we speak. I have no idea. I don't see how Deutsche Bank and HSBC survive this without bailouts, especially HSBC with what's going on in Hong Kong and China and how they've got all their eggs in that basket. But I think they'll most likely get a bailout. And that, of course, brings on another 100 problems with social unrest in the real economy. And if people out there with their small businesses that are going bust and they're locked in their house because they can't go to work, they can't afford to eat, they can't make their rent payments, I don't know how happy they're going to be that Deutsche Bank and HSBC are being bailed out. I don't see how this doesn't end in social unrest unless they start with the helicopter money and the MMT, which we see happening in a lot of countries. Australia has been doing this where they're just cutting checks to people and sending them in the mail. So my guess is that's probably what we're going to see here in the United States as well. I don't know how that would work from a logistics standpoint because the Fed can really only create reserves. They'd have to do it. I guess the government would have to do it, and the Fed would have to monetize that debt to keep rates low. That's an interesting thought experiment to figure that out. But I think it'll most likely come to that. Inigo, thank you for the super chat. When you say stiff drink time, what do you envision? What drink do I envision? I think is your question. Personally, I think of an Oban 14-year whiskey and maybe a shot of Aguardiente. Hey, somebody's been to Colombia before. So I don't know if you're Colombian or you've been here, but I guarantee you've been here, because if you haven't been here before, there's no way you'd know what Aguardiente is. But I don't like Aguardiente. I think it tastes horrible. It's got like a licorice, like an ouzo. Ugh, terrible. Stiff drink time for me. Probably just a good whiskey on the rocks, good vodka on the rocks, something like that. Joe, thank you for the super chat. Do you think the spreads on the run, off the run bond market will return to normal after QE is announced? That would be a much better question for the other George. George Goncalves. So I hope Sebastian put his name up there. Definitely give him a follow on Twitter. But as far as my answer, I think if volatility gets worse, which it most likely will, and as soon as we start seeing some bankruptcies, if that's what we see, or even some bank bailouts, I don't see how the spread doesn't increase. And if you guys are wondering what Joe's talking about, Joe, it sounds like you watched my video on Friday where I outlined the difference between those two treasuries that are the same maturity, but they're different as far as the price that the market attaches to them and the interest rate. Because the on the run, being the newer issued treasury, has a higher liquidity. So there's a liquidity premium attached to it. I didn't even know there was a difference, frankly, until I started talking to George about it and doing research myself. So definitely check out that video on Friday and the interview I did with George on Saturday to know what Joe's talking about, because Joe, that's extremely important. And I would suggest going back and looking at a chart of the 10-year and that on the run, off the run spread back in 2008. And you'll see how it spiked up to above 60 basis points back then. And just on Thursday, it spiked to over 50 basis points. So very close to what we saw when that spike in 2008 was right when Bear Stearns went bust. And then it's actually, I think it might've been when Lehman went under. That's when we got that spike. It was either when Bear Stearns went under or Lehman or both. Jonathan, thank you for the super chat. It seems like the manipulation of the metals prices has backfired on them. Now people can see the shortage and are ignoring spot price. Do you think this will lead to an explosion in the price? I'm not an expert enough on that specifically, Jonathan, to give you an answer. What I would say is I think the price is very low right now. And I think the price over the long term, meaning 5 years plus, will be much, much higher. And I would even probably take that back to sometime within a year, 3 years, it's going to be much higher. And that's all I'm really concerning myself with as far as my own personal portfolio. As far as an explosion due to the underlying mechanics and what's going on with the traders back and forth, I'm not sure. Tommy, thank you for the super chat, buddy. Good to see you again. He says, not to brag. Right. But I haven't been wrong yet. We are watching the system in the process of crashing. FYI, yes, I'm buying the silver miners. Well, guys, Tommy probably knows more about them than I do. And Tommy's right. He's been crushing it with options and playing the downside. And I remember last week, Tommy, you're saying you're like 600% up on one of your trades, just really doing well. So congratulations there. And if Tommy is buying the silver miners, I'm not saying we should all buy them, but I'm saying it's something we should consider and maybe put on our watch list. Connor, thank you for the super chat. As deficits as deficits and the economy get worse, the government bond collateral will get riskier. Then what could banks use as collateral to maintain sub 1% rates? Gold, ? See, this gets really into the weeds because I haven't done a video on it because it's very complex. I tried to kind of just make it easier to digest in saying that the reason gold goes down in this type of environment often is because it sells off, but it actually has a lot more to do with, according to some of the professionals that I've spoken with, it also has a lot to do with gold leasing. And I don't know if through that gold leasing that could be a mechanism to use that as collateral or not. I don't think there'd be enough. I don't think there's enough gold on Earth to, unless the price was much higher. But I'm not sure. I'm not sure. And I don't think that, you got to remember, Connor, even if the collateral gets riskier, and what you're talking about is inflation going up or the interest rates going up. So why would one of these banks want to hold on to that collateral when the price is most likely going down because the interest rates are going up? But you got to keep in mind that a lot of this pristine, quote unquote, pristine collateral that they're hanging on to and trying to buy is short term. It's like a month. It's just T-bills. So I think you're looking at it as though they have to hold 10-year treasuries or 30-year treasuries, and you're not considering the fact that they could own just all this short-term debt. So kind of make sure you're plugging that into your analysis. Stacy, thank you for the super chat. Do you recommend smaller increments than 1 ounce of gold? I don't know. There might be an argument for it, but just for me personally, I wouldn't do that, because I don't really see a need for that personally. But I think it's all pending on the individual and what makes them sleep well at night. I'm assuming you're asking that, Stacy, because if, let's say, the whole financial monetary system came crashing down and we had to barter with gold, which I don't think is a high probability, but that's just me. I totally respect people who have a different view on that. But for me personally, I don't see a real need for that. So I wouldn't do that. But again, if you're someone that sees that as a risk and it helps you sleep well at night, why not? Baxter, thank you for the super chat. Thoughts on the leaked British documents that 4 and 5 Brits will most likely be infected. Excuse me, guys. My throat gets really dry when I do these live streams. I don't know. I'm not a doctor, and I'm not like Chris Martenson, which I'm sure would have a much better idea and take on this than I do. All I can tell you is that it just goes back to the hospital beds. If 4 and 5 Brits, and I don't know where they're getting that, but I mean, it's possible. Let me put it to you this way. If nothing was done about the cerveza sickness and people just went on business as usual, no one self-quarantined, no stores shut down, everyone just kept going to the soccer games, the sporting events, the restaurants, cafes, bars, and completely ignored it, totally, easily go to 4 and 5. I mean, it would most likely, well, I'm not going to say get everybody, but yeah. But the fact that, or hopefully, with people self-quarantining and being smart about this, it lowers the R naught value from 4 down to hopefully as close to 1 as we can get. And you don't have, I'm not going to say it's not that big of a deal, but it's more, the impact is far more muted, and it doesn't get to that point where it's affecting a majority of the population. David, thank you for the super chat. Mike, thank you for the super chat. If I'm not a bank, where should I have my cash? Moving to Mexico soon. If not in a bank, where should I have my cash? I like your back pocket, and I like short-term T-bills, depending on how much you have. Also, if you're with a small community bank, but they might really struggle now. I don't know. I'd prefer it in my back pocket, or at least have some in your back pocket, and short-term T-bills. And obviously, you have to leave some in the bank, and it's FDIC insured. And even though they don't have even remotely close to the money to cover what they have in liabilities, I think they'd be bailed out. And so I just would make sure that I didn't have anything in the bank that exceeded the FDIC limit. Lance, thank you for the super chat. If the stock market crashes again and hyperinflation becomes the norm, what might the global financial reset look like in your opinion? That's a pretty broad question, Lance. I mean, hyperinflation with the dollar, global reset, it would have to go back to like a digital current, like a digital backed government, or like a government digital currency, or a currency that was backed by some sort of hard asset, because I just don't see, if we have a hyperinflation of the dollar, it's all about confidence. And I don't see how you could regain confidence with another fiat currency. So that, I think it's first and foremost starts there. And then you have to say, okay, if you've got a currency that is actually tied to something and not fiat, then it limits the money supply growth. And then the United States economy would be put into a position where it has to consume what it produces. And so the quality or the standard of living in the United States would go down substantially. Because think about how many people you know that have increased purchasing power due to asset prices going up, whether it's a house. And the simple example I like to use is, say someone, your friend and family member Fred, goes out and buys a house for $200,000, and 3 years later, let's say they live in San Francisco, 5 years later, that house they could sell it for $1 million. Well, they've increased their purchasing power by $800,000, but they haven't produced anything, nothing. So my point is, at some point in time down the road, if this plays out like you're saying, Lance, that your friend and family member Fred isn't going to have that additional $800,000 in purchasing power. They're going to have an equivalent purchasing power relative to the goods and services, whether they're an employee or employer, doesn't matter, to the goods and services that they produce. Services, businesses, service business tips for you. Thank you for the super chat. Should I take a risk and buy 100 shares of CCL, Carnival Cruise Lines? They're valued too low right now. Well, I agree with that. If I was going to make that move, I would definitely look at their balance sheet, the amount of debt, and ask yourself if they can sustain themselves with that debt load over the next 6 months. In my opinion, I think you might be better off. Although I think that's an interesting play. Like I said the other day on the video, now I think you might be a little bit better off looking at some of the oil producers that I think are in far less risk of going belly up than a Carnival Cruise Line. Not that they're going to go out of business. That, like an Exxon, as an example, or a Chevron. I think just me personally, that's where I'd start. Michael, thank you for the super chat. Aussie stock market just opened Monday morning and slumped another 7%. Wow. Yeah, Michael, I've got a lot of viewers in Australia, and I just interviewed Alex with Nuggets News last week. We'll be posting that interview this next week, most likely. And it's going to get real ugly for Australia as well. I mean, you guys have that housing bubble there. It's so much of your economy revolves around real estate. And if you guys, and I think that you're kind of following that exponential growth curve for the cerveza sickness as well. And that's not good. So I think, I don't know Australia well at all, but I would assume that there's a lot more downside in your market as well. Tim, thank you for the super chat. What's your best guess as to if or when shorting will be suspended? If they do, what will happen to calls, puts, who wins, who loses? Well, I'd like to also point out, Tim, that they could just shut down the stock market, period. A lot of smart people that I follow that have been market participants for many, many years are throwing that out there as a possibility. So I don't see, what if they say, okay, this cerveza sickness is going to be bad for the next 2 months. Let's just shut down the stock market until the cerveza sickness is better, or until we have a better handle on it. And that's beyond my pay grade. I don't know. I don't know if that's legal. I know they've done it before, but much different time. I don't know how they pull it off. I don't know the logistics. I don't know if it's even possible. I don't know how that would play out. There's just too many unknowns. And as far as the calls and puts, that's based on your counterparty, I would assume. I know that the clearinghouse takes on the risk. So if your counterparty bails, I think by talking to Patrick, this is how it works, that the middleman would take the responsibility for that, but who knows if they stay in business. So that said, I think going back to 2008, if my memory serves me right, I don't think, I could be wrong, but I think that the retail investors that had calls and puts and options, I don't know. I think all of them were made whole. I think, but I could be wrong. Lewis, thank you for the super chat. Great work as always. What would be real hard medicine to take currently? What's the true market correction? I think you've just got to go look at 2008 or 9 levels adjusted for inflation, and then think to yourself, okay, this could be worse, and we could go lower than that. Barring some miracle that the Fed can pull out of their hat that actually gives the market confidence. But I don't, if today didn't give them confidence, what will? And what on earth can they do? It's just they've thrown everything at the market, including the kitchen sink. Where do you go from here? It's like, it's like that bad guy in the Superman movies that's like shooting him and the bullets are just bouncing off him. And the guy shoots his last bullet. Superman just walks up and like bends his gun and then just like punches him in the face. That's basically what the market's doing to the Fed right now. Austin, thank you for the super chat. Q time to load up on debt, expecting that it will be inflated away. Have a lot in rental equity, doing nothing during possibly a once-in-a-lifetime event. Okay, before I answer this, guys, we're going to have to stop this. Oh, my goodness. Yeah, we've got to stop the super chats. Holy cow, I've got a lot. Wow. Okay, yes, no more super chats, guys, or else I'm going to be here for a long time. No more super chats, please. So, Austin, what I'm doing with my equity right now is I'm just trying to take it out while I can. I'm just trying to take it out and term it, get as long of a fixed rate as I can, and just use that as dry powder. Because in my opinion, when we get this crash, the banks, you're not going to have any luck with the banks trying to pull that liquidity out if you want to use that to buy other properties or assets on the cheap. That's what I'm doing. Patrick, thank you for the super chat. And actually, I'm going to give a plug because it looks like you've got a business here, Patrick. So Patrick is with Yerby, spelled Yerby, Heating and Air Service. Patrick with Yerby Heating and Air Service. Thank you for the super chat. Can you imagine a scenario where everyone cashes out, bank accounts, pensions, investments, etc.? Let's just say tomorrow. No, I don't, because it's still, I don't think it's real yet for the majority of Americans. For all of us, it is, because we stay up to date on what's happening. But for the normies out there, I don't think they get it yet. And I think that the Fed would come in and backstop the FDIC and everything that you're talking about before that would happen. But I'm not saying that it won't happen to a certain degree. I'm saying it's just probably not binary. It's like yes or no. It's probably a shade of gray where it happens in some areas or it happens to a certain degree, and but it doesn't like completely wipe out the system. I just don't. I just think they'll print money to infinity and beyond before it gets to that level. David, thank you for the super chat. Repo market video. Gold was going to infinity with QE, but coronavirus. Darn it, I said it. Hopefully they won't demonetize it. But cerveza sickness, nightmare. Assets include gold go down with QE. Please explain. Right. So with the repo market video that I did where gold was going to infinity and beyond with QE, that's going to be long term, David. You've got, when you have this freak out in the system where everyone needs liquidity, they're going to sell whatever they have, and that includes gold. So over the short term, the next couple weeks, the next month, could gold go down further? 100%. I'm not saying that it will, but it definitely could if we look at 2008. But that doesn't mean that over the next 3 years, it's not going to go up into another bull market because of the quantitative easing that the Fed just announced today and everything that they've done over the past few weeks. Zoomer, thank you for the super chat. What are your best investing books you can recommend? What are your thoughts about hot Canadian real estate with low interest rates? Well, I don't like Canadian real estate because it goes back to my philosophy that I want to buy things when they're cheap and sell them when they're expensive. I don't worry about whether or not the price is going up. Or at least that's not my main. That's not for the first question I ask. So I don't think there's anything that is cheap about the Canadian real estate market right now. So I would shy away. Best books, probably first and foremost, would be Beat the Dealer, Black Check book, Edward Thorpe, because you learn how important probabilities are, and to see the world, including the world of investing, through the lens of probabilities. There's nothing more important than that. And also you learn money management skills. You learn a lot of things that are just invaluable. Also, Thomas Sowell, Basic Economics, Henry Hazlitt, Economics in One Lesson. I would look at Schiff's books. I'd look at Jim Rogers books as well. And then I'd look at Market Wizards, all the Market Wizards books. I think there were 3 of them. Make sure that you read those. That's where I'd start. Free Thinker, thank you for the super chat. What 2-year and 10-year or 10-year and 30-year spread indicates hyperinflation is coming? I'm not sure if there's a go-to spread. I would be focusing on the long end of the curve, but I'm not a bond trader, so I don't want to give you a definitive answer because I just don't know, to be honest with you. But I would be definitely looking at the 30-year because that's where you're going to see inflation concerns show themselves the most, from what I understand. Nicholas, thank you for the super chat. Does the cut to 0% rates endanger banks like HSBC? Hong Kong has to follow the same rate cut. And I'm thinking back to your informative video on the coming Chinese banking crisis. I don't know that it does this time because it's steepening the yield curve, and banks want a normal yield curve. When that yield curve gets flat, regardless of where Fed funds is, or inverted, they have big problems. Now, that's the small retail banks. To Jeff Snyder's point, the huge banks like HSBC and Wells Fargo, Bank of America, they're not doing little community lending loans where they keep those, where they lend to local businesses or even mortgages, because once they do a mortgage, they just, as you guys know, before the ink's dry, they sell it to Fannie and Freddie. So it's not as big of a deal for those huge banks as we may think. It is a big deal for the little retail banks who still have that type of business model, which I think are far and few between now. But again, it's not necessarily about the Fed funds rate. It's the shape of the yield curve. Ali, thank you for the super chat. Love your videos. Question: why doesn't the U.S. stock futures updating? I don't know. And how will the rate cuts and QE affect Europe's market? I wish you luck. Well, I'm not sure why the futures aren't updating. I haven't been able to look at them because I don't want to click off this screen. And how will the rate cuts and QE affect European markets? I'm not sure that they really will, because although the QE is definitely providing liquidity for all dollar funding markets, but the dollar liquidity might not be the problem with the European banks. That there could be alternative issues there. So I don't know that it will affect them directly, because I don't know that that's the problem. I think they've got big enough problems. Now, do I think that will keep them from going into a massive recession and prop up the market for long term? No, I don't think it's going to do that. I could be wrong, but I just, that's not my base case right now. Can you, Ken, thank you for the super chat. Can you please talk about the cutting of the reserve ratio to 0 and how rare of a monetary move that is compared to QE and 0 interest rates? For the United States, it's pretty rare. To be clear, Ken, a lot of the banks in the US already had a reserve requirement of 0. There was it was kind of like a progressive scale where if you had X amount in assets, you were required to have a 10% reserve ratio. The higher level, the more reserves you're required to have. But a lot of the smaller banks already had a 0% reserve requirement. So it really only affects the big banks. It's by no means unprecedented because most of the banks outside of the United States already had a zero. They didn't have a reserve requirement, like the banks in England, the UK, and I think throughout most of Europe, they don't have reserve requirements. So nothing new there for the banking system, other than just for the big, huge banks in the United States. Troll McTrollerson. Thank you for the super chat. Is it hard waking up in the morning facing the facts that you're come on. That okay. That you're smart, rich, and smooth. Listen, I don't think that I'm really any smarter than the average Joe on the live stream here. I think we're all pretty much in the same boat. I may be more obsessive compulsive. I'll give you that for sure. So, meaning when I get my teeth into something, if I get focused, then I just have it's laser beam. It's like tunnel vision, and that's all I do, and I get obsessed with it. And that's as you guys can tell, I've been obsessed with macro since 2012, and just that's how I've learned this is through being self-taught and just thinking about it nonstop on a daily basis. But I don't know if that makes me, from an intelligence standpoint, I don't know that I'm any smarter than anyone else. As far as rich, I mean, that's all relative. I was able to retire young, very true. I was a self-made millionaire at 34, retired at 38. I don't know if it depends on what you consider rich. But I am very grateful and I am very fortunate that I was able to work my tail off and that I was blessed with the work ethic and the ability to manage people and things required to turn that into a reality. Of course, like I've said in other live streams, I had to sacrifice a lot. And was it worth it? I don't know. I don't have I don't have a wife. I don't have kids. I've had to sacrifice family. I've had to sacrifice a personal life throughout the majority of the time when I wasn't retired. So there's pros and cons, right? Hi, Viz Economist. Thank you for the super chat. 100% of us took it upon ourselves 6 months ago to Google "is recession close" and came across your channel. Great. We're the outliers. As things fall apart, millions will search that. This channel has unlimited potential, my friend. Thank you very much. And I think you were one of the first ones, along with Tommy and a Suicide Van, a couple others, and I apologize if I'm forgetting your handle. But I think you told me that way back when I had like 200 subscribers. Way back. I mean, that was like 6 months ago. So you called it. That's for sure. I don't think I even believed you back then. But as far as unlimited potential, I don't know. I don't know. Honestly, I don't pay too much attention to that. I just try to focus on improving the videos and honestly, when I'm doing the videos, guys, and I'm thinking through what type of content and what subject matter, I'm trying to make it as relevant as possible. And I'm trying to figure out in my mind, what message can I deliver to the viewer that is, I don't want to say going to blow their mind, but that's going to give them insight that they've never heard before. And that they're gonna get that value out of the video by watching it, not only understanding what's going on, but they're gonna, at the end of the video, they're gonna be like, wow, I never knew that before. That's what I try to do with every video. Hopefully, obviously I don't accomplish that on every video, but hopefully it can have that impact long term. I think if I could just, and that's why I just focus on it, because that's what I like to do. And if the result of that is getting more subscribers or more views, then that's fantastic. Okay, Sebastian's saying check time. I know, Sebastian. I know. I just make sure there's no more super chats, guys. Oh my gosh. Wow. Oh wow. Thank you very much for the super chats, guys. Really incredible that we can get this many people on, but I'm gonna have to fire through these pretty quick. I apologize. You don't believe FDIC will warranty 200 grand? Yeah, I don't. They don't have the money. I can tell you that. They've only got about 100 billion for 9 trillion plus in deposits, but I think that they'll probably get a bailout if they need one. Brian, thank you for the super chat. Gold, silver, paper, COMEX spot price appear to be decoupling from the physical price. Merchants have begun to add premiums to their bullion due to low supply, high demand. What are the ramifications? Well, I think at sooner or later the price there's got to be an equilibrium there. So I think that would be bullish for the price for sure, Brian. But again, it goes back to what is the price going to do over the next 2 weeks? Personally, I'm not concerned with that. I'm just looking at what is the price going to do in the next 5 years, 10 years. And if I can get it at a discount to that, which gives me what I think would be a fantastic return, then I'm going to go ahead and pull the trigger, regardless of the price. That said, I'm not looking at gold and silver the same way. I'm only looking at gold as an insurance policy. So I'm not really concerned with the price there. With silver, then I'm looking at that as a speculation, in which case I am paying attention to the price. I want to make sure I'm clear. So, but me, let's say silver's at $14 and you buy it now and it goes down to $10 or $8. I mean, does it really matter when most likely in 5 years it'll be 50 plus? You get a little bit better deal. I get it. But to me, it really doesn't make a difference. If I'm still making a substantial return or a return that warrants me having the money locked up in that asset, then for me, it's still a no-brainer. Jeff, thank you for the super chat. Choose only one. 50K B of A dry powder until dust settles, or 50K invested Peter Schiff Euro Pacific Capital Fund. Jeff, I can't answer that question. I'm interviewing Peter on Tuesday. Here's how I'm going to get out of this question unscathed. Jeff, watch me wiggle out of this. My answer is going to be, it depends on the rest of your portfolio. If all you have is 50K, then I wouldn't put 50K. I wouldn't put all of my money in either of them. I would put some of it. You want to diversify. You want to have insurance, investments, and speculation. If part of that in cash, of course. When I'm talking about the 100% there, I'm talking about just the assets that you have invested. So if I only had $50,000, I would keep some dry powder, but I would also have some of it invested and just the way that I talked about. And maybe I wouldn't be pulling the trigger right now, but that's what I'd have on my watch list. So eventually I could form that type of portfolio. And I think that taking a portion of that and putting it into with Peter, I think would be a great idea. But I wouldn't put the whole thing in anything. You got to have that diversification. And also, too, when you're talking about putting it in with Peter, make sure you understand, I heard him talk about this on one of his podcasts, that just because you invest with one of his brokers doesn't necessarily mean that you're employing his strategy. You're really only employing his strategy if you go into one of his mutual funds. So make sure that you're distinguishing between the two. And I'm sure that's something we'll talk about when I interview him. Dylan, thank you for the super chat. Thank you for your macro insight into the financial markets, future, high inflation, QE, asset prices down, etc. Where to hide long term? Long term, I think that it just goes back to having some gold as insurance, trying to get some really awesome investments when assets get cheap that pay you to own them, whether that's real estate or dividend paying stocks inside or outside of the United States, and then having some great speculations. And the good news is we have prices coming down so much right now that over the next couple months, we're probably going to get some amazing speculative opportunities in asset classes most of us favor. And that's things like gold and silver and the miners and oil. Hard assets. Satish, thank you for the super chat. Junk bonds seem to have held up relatively better than stocks. Is it due to just a matter of time, or Fed actions can save junk credit? It's a matter of time. The corporate bond market, in my opinion, is going to have severe problems. That's not to say that the Fed can't bail them out. And I think they may be trying to bail them out by lowering the rate on the discount window down to Fed funds. But in the nick of time, I don't know how it's going to play out, but I think the Fed would have the ability, and most likely would probably have the willingness to go in and buy the corporate bond market, especially if they're already buying the stock market. They might have to do both at the same time. Don, thank you for the super chat. How can there be shortage of quality collateral in the repo market at a time record treasury in issuance? I cannot connect these dots. You really have to go back and watch my videos on this, Don. The short answer to that is before 2008, you've got to understand we had a pie, 100% of collateral. Let's say 90% of that pie prior to the GFC was mortgage-backed securities or asset-backed securities. If you wipe out all of that collateral as an option for the repo market, even with the treasuries, you're only left with 10% of the collateral that was there, just call it a month or two earlier, going back to 2008. You're correct. With these massive deficits, they've created more treasuries, but it still hasn't taken us back up to that 100% where we were before. I don't know how, maybe it's gotten us to 50%. Maybe it's gotten us to 80%, 90%. I'm not sure. But the entire pie hasn't been filled up to its limit, or I guess there's no limit, but to where it hasn't been filled up to where it was prior to the GFC, the total collateral pool. Hopefully that makes more sense. And this isn't me talking. This is people on Macro Voices that I've listened to, and more specifically, Jeff Snyder. So if you're not following him on Twitter, I know I mention him all the time, and it's SNIDER, or you've got to check out his blog at Alhambra Investments. Or in my videos, I explain that quite extensively in my videos as well, Don. Funding Jim, thank you for the super chat. Buy gold with helicopter money, or why not debt holiday like a Jubilee? Well, they could do both. I wouldn't put anything past them, that's for sure. But as far as buying gold, everyone's asking me about timing issues. And guys, remember, we're not trying to figure out if the price of gold or silver is going down or up. That's not what we're doing. We're just asking ourselves if it's cheap. That's it. And if it's cheap, you should buy it. If it's expensive, you should not. And I don't think that there's anyone that would argue that, especially silver right now, isn't cheap. So that doesn't mean that you go all in, or you take 100% of what you were going to allocate to the asset class and just load up the Brinks truck. You scale in, do it smart. But I don't know why, if you liked silver, as an example, long term, I don't know why you wouldn't start nibbling right now, just because it's super cheap, and you just know it's going to be worth more in 5 years. So why not? Why try to pick bottoms and tops? That doesn't work. XRP, Bull on the Moon, thank you for the super chat. Just heard, unverified from Pentagon, that they are planning on shutting down the country Tuesday. Wow. First I'm hearing of that as well. Doesn't surprise me, though. This may explain why the Fed announced, This may explain why the Fed announced today, and they will huddle for 2 weeks to create action plan. Yeah. That does make sense. I'm assuming this isn't verified yet. Yeah, unverified. So, guys, this is something we should all pay attention to. Is this happening? We don't know. It wouldn't surprise me, but let's all pay attention to this tonight on Twitter. And in the morning, I'm sure, obviously, news will come out whether or not this is accurate. And thank you very much for that intel. Andres, thank you for the super chat. Welcome to Colombia. Try Hechizara rum. Okay. I'm not a big rum drinker, but maybe next time I go to Trilogía, if we ever can again with the cerveza sickness. I'm just joking. I'm sure here within a couple months we'll be able to go back, but we're probably not going to be able to go to Parque Aris, or at least I'm not, in the next few months, just to play it safe. What can you suggest to first-time buyer on stock market? What do you think about interest rate zero announced today? Well, I've gone over that, Andres, and I've got to get going, or I'm not going to be able to eat dinner. And Sebastian has been on. I got to be cognizant of Sebastian's time. Keep in mind, guys, Sebastian does this on his time off. So I know that everyone thanked him Thursday night, but every time we do a live stream, we should all go on at least once and say thank you, Sebastian, in the live stream, because I couldn't really do this without him or any of the employees, but with this specifically, it's all about Sebastian. I just look at the CAPE ratio long term, and I would ask myself, where's the mean, and when does the market get cheap? And when the market starts to get cheap historically, then I'd start building that watch list, and I'd start considering pulling the trigger. Vince, thank you for the super chat. Peter Schiff will tell you that long-term gold is going to the moon. How do you reconcile your reluctance to have more than 10% gold and yet be a long-term investor? Because it's insurance for me, Vince. It's insurance. You've got to understand that gold can go to $50,000 an ounce, and it doesn't mean that it's going to have any more purchasing power than it does today. It could just stay consistent with inflation. Now, it could go up in real terms, and it most likely will, but it might not. And none of us can see the future. None of us, not Peter, not especially not George Gammon, but no one can. So why would you take that risk when, who knows? I mean, it's a very low probability, but gold could be worth less. I just don't understand. And I like the saying that you don't own gold to get rich. You own gold to stay rich. I think that's very important that we recognize that. And I'm not saying that it won't go to 50,000 and you could increase your purchasing power wildly. But I am saying that over the long run, I think that gold is just a way to protect your purchasing power. And if you get rich, great. But there's just no way that I would put 100% of my portfolio in anything, because no one has a crystal ball. I guarantee you Peter doesn't have 100% of his. In fact, let me write this down as a question. So what I'm writing down right now is what percentage of Peter's own portfolio he allocates to gold. And I 100% guarantee it's not 100%. So that'll be a really interesting question for Peter on Tuesday. Charlie, thank you for the super chats. Got to be here in Colombia. He's paying me with pesos. You're in Colombia. Welcome, man. I like your videos. Thank you, Charlie. I appreciate it. I love your country. I love spending time here. I don't consider myself a resident of any country. I try to bounce around a lot, but I sure do enjoy the time that I spend right here in Medellin. That is for sure. Road Warrior, thank you for the super chat. Are you ready for FDR 2.0? Yeah, no kidding. I think you hit the nail on the head there. For sure. So yes would be my answer to that. Michael, thank you for the super chat. Looks like he's from Oz. Good day, George. Technology stocks, specifically semiconductors, presumably in this new digital world, will become increasingly good buys. Thoughts? I don't know enough about that sector to give you a yes or no, Michael. I just know that those are generally growth stocks. I don't, maybe I'm wrong, but I don't know how you could get those at a really low multiple. But if they get cheap, it might be an interesting speculation. And I don't know that most of them pay a dividend, so I wouldn't consider them an investment. But if they get cheap, historically speaking, then I would, if I understood that sector, and I don't, but it sounds like you do, I would consider them for a potential long-term play. But right now, as far as the NASDAQ or the main tech stocks, they're not even close to cheap. So keep that in mind. Okay, Chadism, thank you for the super chat. 3 KC houses. Should I have waited? What's the next opportunity? No, I don't think so, Chad. I wouldn't look at it like that, because if you got a great deal, if it makes sense on paper, if the numbers work out, if you got them in good neighborhoods, then they're going to be great long-term investment. As long as you're cash flowing, I wouldn't look at it like that. I might try to pull out some equity to maybe have a little dry powder and then take advantage of the next opportunity. But I wouldn't play the whole woulda, shoulda, coulda game, because that's a fool's errand. And you're never going to time the market. And that's why you always, with the investment side of your portfolio, I like to use my buddy Jason Hartman's saying, and it's got to make sense from day one. If the investment doesn't make sense and pay you to own it from day one, you shouldn't buy it. Miguel, thank you for the super chat. I either give it to the Fed or you now take my money. Thanks, buddy. I appreciate it. Whippy 123, thank you for the super chat. Can you imagine negative interest rates on mortgage loans? Sure. Yeah. I don't think that you're going to make out like a bandit, because I think that if they do go negative, I think Denmark has a couple banks that have negative interest rates on mortgage loans. You're still going to pay. It's just you're not going to pay in the interest rate. You're going to pay in the fees. You're going to pay in having your checking account just nickel and dime you to death. The appraisal fees. It's just they're going to nickel and dime you to death to get the money from you that they otherwise would have made with positive interest rates. So I don't think anyone should fool themselves into thinking that you're going to get paid to have a mortgage. Now, on the at first glance, yeah, they may pay you, but when you look at it on net balance, you're still going to be paying them. Hopefully that makes sense. J6, thank you for the super chat. Review limit breakers. Okay, I'm assuming you're talking about that when the market now has circuit breakers in place, where if it goes down, I think it's 7% is the first one, they stop trading for 15 minutes. If it goes down, I think it's another 7%. Don't quote me on this, but I think it stops another 15 or half hour. Then if it goes down like 20 minutes, they just close the stock market for the day. They started this, or they increased the level of circuit breakers after 1987. So my point there is that make sure you understand that you can't really compare the downside we have today with 87 because we didn't have those types of circuit breakers in place. If we did, they weren't as strict as they are now. So that's how that works, guys. It's the market has those circuit breakers. Okay, whew. I think that's it, guys. Thanks for being here. Let me go over just as a reminder. You guys have just a couple hours to make sure you take advantage of that affiliate promo that we have with Katusa Research. That's $1,500 off. That goes to $11:59 tonight Eastern Standard Time. And if you want to take advantage of that, there's a link. We'll put a link in the description of this video. Also, there's a link in last week's live streams and the interview I did with Marin. Also an affiliate link on our website, georgegammon.com. On the recommended resources, you click the newsletter and you'll see the affiliate link there. I would strongly suggest it if you've thought about purchasing a resource newsletter in the past, and especially if you thought about purchasing Katusa Research. If you haven't, then it's probably not right for you. But if you have, now's a great time, great deal, and we can potentially clean up on resource stocks in this downturn if we know what to buy, and it's a great way to support the channel. And I'd also like to point out my good buddy Jason Burek with Wall Street for Main Street. He typically does a live stream right after I do. He said he was starting at 8:30. I ran a half hour over. So if you guys want more of this type of content, just shoot over to his channel right now. That's Wall Street for Main Street. I don't know if he's still live streaming, but he might be. Other than that, guys, remember, we got to change the schedule. No whiteboard videos next week, but I'll still be uploading content. And I will see you guys tomorrow on the next video.